Imagine you've signed a contract for $100,000. The project's moving along, everything's great, and then your client asks for just a small change. It seems simple, right? But that one little change can totally unravel your revenue projections if you don't handle it the right way. So, how do you deal with this? Let's break down the rules, because getting this right is a really big deal for your bottom line. Okay, so the contract changes. Do you just treat it like a brand new deal? Do you just tweak the price on the old one? And what does this do to the revenue you've already booked? Well, these are the exact questions that the accounting standard IFRS 15 is built to answer. And it all starts with understanding what the rules actually mean by a modification. All right, first up, what is a modification anyway? Before we dive into the tricky stuff, we gotta start with the basics. The word modification sounds pretty simple, but in the world of accounting, what seems like a simple change on paper can set off a whole chain reaction of rules. So let's nail down what it officially means. Okay, here's the textbook definition. A contract modification is a change in scope or price or both. But the key word here is approved. And that doesn't always mean a fancy signature on a dotted line. Depending on how you do business, that approval could be in writing. It could be a simple verbal agreement, or it could even just be implied by how everyone's acting. You might call it a change order or an amendment. It doesn't matter. It all falls under this same umbrella. In the real world, this could look like adding a new feature to a piece of software, extending a service contract for another 6 months, or maybe upgrading the materials on a construction project. But now that we know what a modification is, the big question is, what do we do about it? And before you can even think about the numbers, IFRS 15 makes you stop and ask one pivotal question. And believe me, the answer changes everything. Okay, section 2. This is it, the big question. You see, IFRS 15 basically boils this whole thing down to one critical question. Think of it like a fork in the road. Answering it correctly puts you on the right accounting path. But if you get it wrong, you'll end up in a completely different place. Everything comes down to this. So it's actually a two-part test. First, you have to ask, are the new goods or services distinct from what's already in the contract? And second, if they are, does the new price reflect what you'd normally charge for that item on its own, what we call its standalone selling price? Let's take a second and unpack what distinct actually means here. So something is distinct if your customer can actually use it and get value from it on its own or with other things they already have. The easiest way to think about it is, could you sell this new thing separately? Does it have its own value? If you're nodding yes, it's distinct. But if it's just tweaking something you've already delivered or promised, then nope, it's not distinct. Section 3, the 3 accounting treatments. So based on your answers to that two-part test, you're going to go down one of 3 very different paths. Each one has its own accounting treatment, and getting a grip on these 3 is really the key to the whole thing. First up, let's talk about type 1, which is treating the modification as a separate contract. This is by far the cleanest, easiest way to handle a change, but it only works under very specific conditions. This one only applies when you can answer yes to both parts of that big question we just talked about. The new items are distinct, and the price reflects their normal standalone market value. This example is perfect. The new software module, you can sell that separately, so it's distinct, and it's priced at its standard rate. So the beauty of this is, you just leave that original $10,000 contract alone, don't touch it. You just spin up a completely new separate contract for that $2,000 module. Easy peasy. Okay, but what happens if the answer to that first big question, is it distinct, is a no? What if the new stuff isn't distinct? Well, that sends us down a totally different road. And yeah, it gets a little more complicated. This is for when the change isn't really adding something new, it's just changing the original thing you promised to do. The old stuff and the new stuff are so tangled up that they really just become one single performance obligation. Think about it like this: upgrading materials on a building that's halfway built. That upgrade isn't a separate product. It's now part of the one factory you promised to build. In this case, you can't just move forward. You have to go back, recalculate everything, and make what's called a cumulative catch-up adjustment. You're basically updating the revenue you've already booked to match the new reality of the deal. And that brings us to our third and final option, a prospective adjustment. This is kind of the middle of the road scenario, the path you take when you have a mix of answers to our key questions. And it leads to a completely different accounting treatment. This path is for when the new stuff is distinct, but the price isn't what you normally charge for it on its own. Maybe you're giving a loyal customer a special discount. The items are new and separate, but the price is clearly tied to the original deal. A great example is a subscription service. Halfway through the year, you add a new premium feature, but you give it to existing customers at a discount. That feature is distinct, but the price isn't standard. With this one, you don't mess with the past. What you do is, you effectively kill the old contract on the day of the change, and you create a new, kind of blended contract that covers everything left to deliver. It's all about looking forward. Section 4, Summary. Okay, we've walked through 3 pretty different paths, each with its own logic. I know that was a lot to take in, so let's put it all into a simple chart. Think of this as your cheat sheet for any contract modification. See, this table makes it so much easier. You just follow the flow. Always start here. Is it distinct? If the answer is no, boom, you're done. It's a cumulative catch-up. The price doesn't even matter. If the answer is yes, then you go to the next question. Is the pricing standalone? A yes there means it's a whole new separate contract. A no means you're doing a prospective adjustment. That's it. That's the whole decision-making process right there. Look, knowing the theory is great, but what really counts is getting it right when you're actually faced with one of these changes. So let's wrap up with a few practical tips to keep in your back pocket. The biggest thing I can tell you is this: follow the process every single time. Always start by checking if the items are distinct. Always validate the pricing. And this is a big one: document everything. Write down why you chose the path you did, because trust me, getting this wrong can seriously mess up your revenue numbers, and that is a conversation nobody wants to have with their auditors. You know, at the end of the day, this isn't just about ticking boxes and following some abstract accounting rule. It's about making sure the numbers you report are the truth, that they accurately reflect the promises you've made to your customers and what your contracts are really worth. So from now on, when a client asks for that one little change, you'll know exactly where to start. And the last thing I want you to think about is this: take a hard look at your current contracts. Are your internal processes really ready to handle these changes the right way every time?